Welcome to TradeTheMBI.com. This is John. This report is for the 28th, the end of the month, and, well, it's been a record-breaking month. We'll see if it continues one more day. We've got the big speech coming up in the evening after the market, so whether the exuberance can stay with, depending on what some of the leaks are coming out of the speech, and will it be enough to cause investors to get excited. The reality is, look at this, we've got shorts dipping back below the zero line here, meaning they're fading the situation again after pushing through. Does that mean that there's enough juice to continue to push to new highs? Well, we've had short-term buyers jump back in, coming in late, and what we're seeing here is the red DOC starting to fade off a little bit, which means your overbought conditions are fading now. We've been in the yellow range, so we're right at the edge of it, which is why we really haven't propelled very much. So a lot of the short cover has just been enough to hold things up. And this is an interesting one because, I mean, for those that remember the mid-90s rally and how it seemed impossible that everything was ridiculously overbought and it just kept going and going. The reality is, from a business standpoint, if you're looking at equities, you're seeing a Fed that's somewhat hamstrung on how much they can do as far as rates. You're seeing the potential of massive deregulation, which is definitely going to help the bottom line for a lot of companies, as well as the fact that the potential for tax reform and or tax relief and repatriation of money. So there's a lot of potential upsides getting factored into a lot of these price move early on. And as I've said before, and I mentioned this, many moons ago, the biggest change will be in the multiple of the market, where people can see that things seem overbought relative to their version of what price earnings ratio should be. But that can change based on perception, and moving from a no growth to pro growth stance is certainly something that people haven't experienced in a decade. So it's certainly going to cause people some consternation. And you could get, like we saw back in the 90s, where you just continue to keep rising a little bit with very tiny dips going back through. So we don't know yet if that's the case, but so far with these readings, there's nothing that's changed as far as the general bullish stance. Now, when we start to break below some of these things, that will be the test. I mean, we have our ABMs to follow at the various levels. If I click that, you can see this. In fact, I should put the ES back there because I went too far with that one. Let's go ahead and click what these ABM values are on the ES all the way down to 2340. So, I mean, you could get a significant dip that's only just going to fill back in basic levels. So, but it's neat to watch the NQ with that shakeout having dipped dramatically, which really resets things quite a bit. You see a much more dramatic decline in the overall DOC red here, and the orange is out of that 13.5 range, which could take away some of that downside stress that it feels when you get to those extreme points. The euro, the central bank's holding it right at that level. I mean, they're just doing their best, and it's not easy because the headwinds are tremendous in Europe with Le Pen and everything else like that taking place. There's a lot of uncertainty, and that uncertainty is definitely causing money to flow into America. The bounce in bonds, didn't think that that was going to be substantial, particularly since now you're looking at a huge number of people believing that the Fed will hike in March to kind of cool off the Trump rally, though there's really no indication that inflation is in any way, shape, or form out of control to the point where it's necessary to do so, and it may actually be an unnecessary hindrance to growth, particularly since, as we've talked about it before, just because there's been a lot of hype and the market is getting ahead of where things are, it hasn't translated technically yet into the economy, and it's going to take many months. So I think any move by the Fed would be premature and not too different than what Bernanke did when he came in worried about inflation and overhike rates and created the depression that took place after. They call it a Great Recession, but without the massive $10 trillion spent, it would have been clearly a depression. Oil, this power of the U.S. economy and or oil industry to just ramp up. You're seeing that now with the U.S. now exporting record amount of oil, which never was allowed to do before, which certainly changes the dynamic and really removes the power from OPEC. It's going to be difficult for them to counter it. Throw in the pipeline potential completion by March or so, and you could have a whole new dynamic as far as what oil can do in the future, which that's where the economic growth engine is going to really determine what happens there, because if you can keep oil prices down while growing, it's just going to be an explosion. And gold is still going to be the hot run. It got a little overbought, needed to fill back in that peak there, but overall, still potential for continuation is there. And we had our 2360, we were pivoting along, and like I mentioned before, the breakout from it, given how many days it was, if I shrink this, we can see. Let's slide this back over. We pivoted across it back and forth for quite a few days. And that's a significant build. Now, we're going to start the month where new flows are going to come in. It's a little early for that, so we'll see. But depending on how significant they are and whether or not the market likes what it hears from Tuesday's speech, and whether there's any specifics on what the plans are, certainly could impact the market dramatically. So that will definitely be on everyone's mind going forward. I'll be sending out the indicators so you'll have them. You can either put them in pre-market and or after the market, and be all set for the beginning of the month, which is in a midweek situation. So a lot of interesting and exciting things, and the readings have been spot on. Oh, I wanted to show the Opus, because we've had a few trades go on in between there. We're right at the precipice of equity highs. Let me show this version of the, go into the calculation mode. So from a periodic standpoint, just to start out the beginning of the year, looks fairly decent from a summary standpoint. We're still right at about that 76% win rate over the last, well, geez, this goes 13 plus years, so it's quite a significant run. And you can see we're right up at the peaks. We had that little bit of run, and a couple of those we knew were weak trades that took place going through there, and some of them were add-ins. That's okay, because we were able to navigate through some of that, and this was the other version of the same. And let's take a look at this one. It's a little bit less from an overall return standpoint because it treats it a little differently. And we go to periodic returns, exactly the same, and that's just because it's starting again, likewise. So very effective. Now, the 50K, making some adjustments to that one, because whereas something like this, with the cyan into the red, making those adjustments to continue the run, because that would still leave us in this trade, and that is going to change how this program functions dramatically, and I think that's going to be a huge improvement, because it's not going to get cut out short on some of these moves, which I think that has always been the goal with it, to continue to follow in an aggressive way. Don't want to run too long here, but we're seeing a little bit of softness to start out. I don't see that as being problematic at this particular point. We'll have to see. We didn't get a full reset on oversold, so we could get some more stagnation going across there. But as always, though, continue to look for me on the Skype chat. Trade well.